Hello students, good morning to everyone. I am Rasmiranjan Mishra, the lecturer and head of the department of Bachelor of Business Administration, UN Autonomous College of Science and Technology. Today we are going to discuss a brief introduction or overview regarding financial market. So first we have to discuss what is financial market. Any type of a financial transaction that you can think of that helps business grow and investors make money. That means financial market means where financial transaction or monetary transaction take place, and that is in terms of a buying of a share or securities, bond, debenture, etc. And that helps the business, that financial market helps the business to grow. That means to increase more and more or to generate more and more profit, and that also helps the investors to make their money more profitable. In other words, market where entities can trade securities or financial securities, commodities at a low transaction cost and at prices that reflect supply and demand. In other words, we can also say that financial market deals with various types of entities or the organization. Different organizations, they can trade financial securities or different types of commodities, that means gold, silver or any type of commodities that is at a very transaction cost is very low, and that also taken into consideration the supply and demand, that both take into consideration to determine the price. Securities includes stocks and bonds, commodities includes precious metals, that is gold or agricultural goods. In financial market there are different participants. So the participants in financial market are, one is investor who is called as buyer of securities, those who wants to purchase various types of stocks or securities or commodities. Another one is borrower or seller of securities, those who wants to take money by selling of their securities or commodities. And in between them there are different intermediaries, that means they are taken as the role player or they are called as the middleman that helps both buyer as well as the seller of securities. And another one is the regulatory bodies, that means those can regulate the financial market or under whose rules and regulation the financial market is regulated, just like SEBI, Securities and Exchange Board of India. Another one is RBI or any type of regulatory bodies are there under whose guidance or under whose regulations or whose rules, any type of guidelines the financial market is regulated. They are called as the intermediary. So in financial market, one is investor, another one is seller, another one is intermediaries, and the last one is the regulatory body. Next we are going to discuss the purpose of financial market. Why financial market exists? Financial market facilitates, the first one is raising of capital. That means those are having surplus money, those think that their money is not needed in near future, they want to invest their money in financial market and they want to grow their money, that is called as raising of capital. And financial market helps the investor to raise their capital by investing that money in different types of stocks or securities or commodities and to make it more profitable or to grow more avenues. The second one is transfer of a risk. Here risk is transferred or risk is shared. Our money or the investor money is not invested in one category, rather than they are diversified in various securities where if one side there is loss, in other case there may be profit. So the risk is diverse or that is transferred. The transfer of risk or the investors can minimize their risk by investing their money in different categories to minimize their loss. The third one is international trade. In financial market, investors, they not only trade in one country, they also invest their money in outside country or which is called as foreign exchange or foreign markets. So in foreign markets, investors invest their money and that helps for trading, that is called as international trade between two different countries, that makes more profitable between the countries or the economic growth can be increased. Then what is the functions of financial market or the role of financial market? The role of financial market in the success and strength of an economy cannot be underestimated. Generally, financial market plays very important role for the economic development of the country. So we cannot underestimate that their role. Here there are four important functions of financial market. One is put savings into more productive use. we can invest our money, or the investors can invest their money in financial market, and their money is to be utilized in more productive use. That means, suppose I want to invest my money, I am having certain surplus money, and that money is not utilized in near future. So I want to invest my money in banks in the form of a fixed deposit or recurring deposit, or I want to invest by purchase of a shares, securities, or any type of a commodities, or rather I purchase various gold or any type of a precious metals. So that money can make more fertile, or in near future that can make me more benefit, which can support me, or I can make more and more profit. That is called as put the savings into more productivity use. So financial market supports that. Financial market provide the guidance, investors provide the guidance to the investor that you want to invest this money in this area so that you can utilize money more fertile, or your money can make better investment, or your money can make go or grow more profit. The second one is determine the price of a securities. Here the price of securities is determined by financial market. Unlike in general market, the goods and services, their price is determined based upon the demand and supply. But in financial market, the price is determined on the basis of a market situation. When market is favorable, then price of shares or securities can increase. When market is unfavorable situation, in that case the price can fall. The third one is makes financial assets liquid. That means investor, they wants to invest money as and when they require, and they can also sell their money as and when they require. That is called as liquid. Anytime or any time investors thinks fit, they can purchase it, they can sell it. And the last one is lower the cost of transaction. So we already discussed from the first that financial market provides transaction or monetary transaction or financial transaction at low transaction cost. So here the transaction cost is very minimum. A certain percentage of commission, or which is called as brokerage, that is charged, and that is taken the financial market for providing that financial service. Then we are going to discuss what is the importance of financial market. Financial markets provide a place where participants like investors and debtors, regardless of their size, will receive fair and proper treatment. So whatever may be the investment, here that is not taken into consider. Any type of investor, they can invest their money if they are following certain formalities, or they are coming under the rules and regulation. So all type of investors or debtors, regardless of their size, that means we cannot take into consideration their amount of investment. Whatever may be the investment amount, they can invest in the financial market, and that will receive fair and proper treatment. All type of investor, they receive fair and proper treatment. They cannot be harassed, they cannot be underestimated. They are guided through registered brokers, or they are guided through registered participants, or they are called as the regulation. Those are called as the regulatory bodies. Under their guidance, all type of investors, they are guided. So that provides fair and proper treatment to all investors, whatever may be the investment amount. The second one is they provide individuals, companies and government organizations with access to capital. So financial market taken into consideration all. Individuals can coming into, company also can taken into consideration, government organization also, they can invest their money in financial market. So all type of participants, they are coming into financial market, or financial market provide facility to all. They may be individual, they may be any type of a government or private organization, they may be private companies or public sector companies which access to capital. The next one is financial market help lower the unemployment rate because of the many job opportunities it offers. This is the most advantageous point, or important, one of the important point, that is called as lower the unemployment rate. That means regardless of their opportunities, those who wants to take the facilities of joining in financial market, they can also, by going through certain certificate or by taking admission in financial institution, by completing their course within a certain period, they can enter into the financial market, or they can conduct all type of service, or all type of employees, they can taken into consideration, which is called as unemployment facilities can be also reduced. If one wants to join in financial market, or they wants to make their career in financial market, so by going through or taking admission in certain course, they can easily access to the financial market or provide service facilities. So that reduce the unemployment rate because of many job opportunity. Various types of job facilities are introduced in financial market, and everybody can access if they are having that qualification. So how financial market works or regulate? One is borrower. Generally we discuss that in financial market, one is investor having surplus money, another one is borrower having deficit money. So who is the borrower? Borrower issues a receipt to lender promising to pay back the capital. I am having surplus money, I am the investor. Another person having deficit money, he or she wants to need money. So I provide that money to that person. That person is called as the borrower. So borrower always issues a receipt to the lender that I am going to pay back your amount within a certain period with certain percentage of interest or additional benefits. The second one is called as your receipts. That means securities which may be freely bought or sold. Here the shares or securities or commodities etc. that can freely transacted, that can be bought and sold. And the next one is your lender. Lender will expect some compensation in form of interest or dividends in return. That means investor when invest money, he is having certain take benefit, or he always having certain objectives that if I will invest money in this category, so ultimately I will receive additional compensation, that may be in the form of interest or that may be form of a dividend. So always investor expect some compensation. If investor invest money in the form of a fixed deposit, ultimately bank will provide certain percentage of interest. If investor purchase shares or stocks of certain companies, then company after certain period or 1 year must provide dividend on the basis of a number of shares held. So always investors expect certain amount of a compensation. That compensation may be in the form of interest or dividend. Then we are going to discuss regarding the types of a financial market. What are the different types of a financial market? So the first one is your capital market. Capital market, under capital market there is one is called your stock market, second one is your bond market. So first we will discuss regarding stock market. Stock market provide financing through the issuance of a share or common stock and enable subsequent trading. So here in stock market, investor invest their money by purchasing shares or stock of reputed companies, or those companies shares are listed in stock exchange, either in Bombay Stock Exchange or in National Stock Exchange. Investor can easily trade by investing their money. The second one is bond market, which provide financing through the issuance of a bond enabling subsequent trading. So like stock market, bond market is also same type. That means here bond, that means one type of a credit instrument which is issued by the company or any type of organization. Those are having need of money, they want to issue that bond, one type of a credit instrument, and those wants to invest their money by purchasing bond, they can also invest their money by same procedure. And in bond market, the investors expect a certain percentage of interest which is assured by the company to their investor, that we are paying this much amount of interest with a certain number of years. But in case of a stock market, the price may be increased, may be decreased, and a company that dividend provided, that is on the basis of a profit. If profit is not there, company will not provide any type of a dividend. But in case of a bond market, company must provide certain percentage of interest which is predetermined. This is the most important difference between stock and bond. Then the next one is commodity market. In commodity market, the gold or precious metals or any type of agricultural goods that is traded. Next is your money market, that provide short term debt financing and investment. In money market, both debt financing as well as investment is traded, and that is for very short period, generally within 1 year. Derivative market, that is another type of a financial market that provide instrument for the management of a financial risks. It is coming under your instruments which manage the financial risks for the investor. Another one is your insurance market, which facilitates redistribution of various risks. In order to protect our life or in order to avoid the risks, we have to make insured with certain insurance companies, and that insurance companies is coming under insurance market. Here regulatory bodies is Insurance and Regulatory Development of India, IRDA. Then another one is your foreign exchange market, which facilitates the trading of foreign exchange. That means here the trading take place between two different countries. Investor invest their money in outside market in terms of a foreign exchange rate. Next is raising capital. Without financial market, borrower would have difficult finding the buyer themselves. So financial market provide facilities between investors and borrowers. So without financial market, borrower would have the take the difficulty position and they are having difficulty finding the buyers. Here the intermediaries such as bank come into picture. So bank plays an important role, or the middleman which is called as the broker, they plays an important role between borrower and the investor, or investors as well as the those wants to take money, having surplus money which is called as investor, and another one is issuer, those are having deficit money. Bank take the money from those who have money to save. So here investor having surplus money, their money is kept idle, having no further use. So bank take the money from the investor. They can then lend this money to those who seek to borrow. Bank popularly lend money in form of a loan and a mortgage. So the amount of which takes the bank from the investor, that is in the form of a loan or mortgage, and again that money is provided to the borrowers. Those are having deficit or those are having need of money. So this is the relationship between lender, individuals and companies. Intermediary, the financial market is there, another one is borrowers. All under borrowers there is individuals, there is company, there is government, maybe central government, state government, municipalities, public corporation, anybody they can borrow if they are having need of money. Financial market, that is stock exchange, money market, bond market, foreign exchange market. Intermediaries, different types of middlemen, those are called intermediaries. There are banks, another one is your insurance company, another one is your pension fund, mutual fund, and generally lenders, those are having surplus money, they are called as also individuals or companies. This is the detailed relationship between all in financial markets. So the next one is your lender, who are called as the lender, and one individual who is called as also lender. Many individuals are not aware that they are lender, but almost everyone lend money in some way. A person lends money when he puts money in a saving account at a bank. So I am having surplus money, I deposit my money in a bank because I am having no further use. So instead of keeping my money in my hand idle, or that is not safe, I want to deposit my money in a bank or any financial institution or in financial market in the form of purchasing shares or securities. Then another one is contributes to a pension plan, pays premium to an insurance company, invest in government bonds, invest in company share. So individual invest their surplus money in different categories, either invest in bank form of deposits, either invest by paying insurance premium, or invest in government bond taking fixed amount of interest, or by purchasing company share, or contribute to different type of pension plans. So this is the detailed category of individual having surplus money. Another one is company. Company also coming under lender. Company usually tend to be borrowers of capitals, but when they are having surplus cash that is not needed for a short period of time, they may seek to make money from their cash surplus by lending it, by investing in bond and stock. So company here it is called as the borrower of capital, but when company having surplus money and that is not needed in near future, company seek to make their money from their surplus by lending it in the form of a bond or by way of stocks. Next is borrowers. Under borrowers, one is individual, that is bank loan or mortgage, company for short term or long term cash flows or for future business expansion, government for spending requirements or on behalf of nationalized industries, municipalities or any other public sector bodies, public corporation also coming under borrowers, that is postal service, railway company or different types of utilities companies. So next one is your financial market efficiency. How financial market provide efficiency in today's scenario? One is your allocative efficiency. A market is allocative efficient if channel fund to those firms and organizations with most promising real investment opportunity. So in every cases financial market always takes into consideration that whatever money that takes from the investor, that money should be utilized properly, should be invested properly, so as to make more fertile or to make more and more avenues. That is called as allocative efficiency. Always market thinks, or the financial institution, they think that our money should be utilized or should be invested in proper way. So they can choose it, which is the best source, which can get more revenue, or in which area we want to invest our money that make more fertile or more revenue generation. Another one is operational efficiency. Operational efficiency carries its operation as low a cost as possible. So financial market always takes its operational activities in the form of a transaction cost, and that transaction cost should taken into consideration as low as possible. Then next one is your information processing efficiency. Any new relevant information that is quickly and accurately impounded in prices. So what are the rules and regulations implemented by different regulatory bodies? Financial market provide all type of information as and when needed or as and when published, and that is provided to the investors or to every market participant. So all type of relevant information that is quickly and accurately impounded in prices. Finally, we conclude what is that. At the end, we say that financial market acts as a backbone of a financial structure of any country. Any type of a country, their backbone can be determined, or country's situation can be determined by taking into consideration that financial market. If financial market is properly designed or their structure is properly maintained, ultimately that act as one of the most important backbone, or that take as most important role player. Second, it acts as an interface between prospective buyer and seller. So we say that in financial market, borrower as well as the investor, that means buyer as well as the seller, they are playing their role, and financial market provide guidance or providing support, take the money from the investor and provide the money to the borrowers. Improve overall business liquidity. All type of investors, they want to invest money at any time they think fit and proper, and those wants to take money, they can also take money as and when that needed. So liquidity is also possible in financial market, or financial market provide that liquidity facilities. It helps in raising capital and improving international trade. By taking the money from the investor, that money can be utilized or invested in a proper way, so that revenue can be generated at a better. So that is called as raising of capital, as well as it also facilitates improving international trade. We can invest our money not only in our country but also in outside market, that is called as international trade. When trade takes place between two different countries in different denomination of currency, so that is called as international trade transaction, and financial market provide that type of international trade transaction. So that is also another type of facility provided by the financial markets. Thank you all.